Guys, hope everybody's doing well.
The video work or video work?
Morning.
Let me go and share my screen. We'll go ahead and get started, guys. Take a look at this. Okay. You guys able to see my screen? Yes? No?
Yeah.
Perfect. So a couple of things, guys, I want to talk about. First, welcome to the event. For a couple of things I want to talk about here, and then I'll open up for some questions. I want to start off talking about Verizon Wireless, because this is one that I entered today, and I ended up closing it out. And I'm going to tell you why I closed it out. I still think it has some legs to run, but just before the call, I went ahead and closed this trade out. So I had my stop in on the trade as I entered it. Good reward to risk ratio. But the thing about Verizon, the thing I didn't like about the particular trade was there's other opportunities out there right now that I've been spotting, which I'm going to go over in a minute, and tie my money up into a trade like Verizon when the technical indicators are showing me that it's moving down, or at the very, very best, going to consolidate. I decided that it's not something I wanted to go ahead and stay invested in. There's too many other trades that were coming up on my list. And when I saw this trade, it moved down, even though it moved above the area that I was looking at, the 5680 area, it stayed above that. That's 5691 right now. But being the fact that there's other trades out there, I decided to close this one out and start to invest in other trades that were better positioned. So one of the trades that came up on the radar, and this came from Megan, it's actually one that I actually posted in the group probably about 3 weeks ago. This is a semiconductor company, and Megan just reminded me about it today. But it's something that's been on my watch list that I've traded before, made some money with it before, and I just recently entered the trade probably about 10, 15 minutes ago. Is actually, you know what? I have not entered the trade. I take that back. I have not entered this trade. I have an order sitting, but I'm looking right now. My order has not been triggered on my trade. Let me just take a look to make sure that's the case. Yeah, so my order has not been filled yet on this particular position. I never rush into a trade. I want to get into this trade, and I will enter this trade before the closing day, but I have an order set on the October $34 call options for $6. And so if we go to this, let me go to this right here. So it's trading for $6 by 610. My order has not been filled. So I take that back. It has not been filled, but it is sitting there at $6 per contract. Now, let me talk a little bit about what I will do. I mean, if this doesn't move down and I don't get filled about the last 30 minutes of the marketplace, I will go ahead and manually readjust my order and get filled. You can see now the spread is changed from 6 to 620. But I'll go ahead and get filled whatever price that it's on the chart at that time. And the reason I wait until the last hour, the last 30 minutes, typically you'll find in the morning the options get overinflated because you have a lot of amateurs that trade in the morning, and we always say amateurs open up the market, the professionals end up closing out the market. So I always say patience pays, and I'm going to wait, and I'll take a look at the price point in the last 30 minutes. So let me talk a little bit about why I like this stock. So just as a reminder, and there's an article that I kind of wrote up in the discussion somewhere. You can go take a look at that later. But ON Semiconductor is one of the big players for partners of Tesla. So it's really a behind the scenes type of a company. And but this company deals with a lot of the autonomous driving. Tesla is using them, as well as other EV vehicles are using them as well. And I think with the shortage of semiconductors, we're going to see, we're already seeing a high demand. We're going to see a higher demand. And I think this stock continues to run. So you can see here using my 8 and 21. And I know Julie is new on the call. I don't know if Julie, you had a chance to go through and take a look at the technical indicators. I think you probably did, because I think that's what you said you were going to do. But I have it set up where I use the 8 and 21 on a 4-hour chart. And I know some of the guys like in the UK and I think in Canada don't have access to the 4-hour charts, but here we do in the US. And what I do is I wait for a crossover on my 4-hour charts. We got that today. I set my order based on whatever stock I want to take a look at. before I even take a look at the option, I'll go through and I'll identify where do I think that this stock could potentially go. And I believe that it can get to about $45, $46 a share. The last time was about almost $45 a share. I think if we can get a move above the 200-day moving average, we will see this thing go to close to that, $45, $46 a share in a very, very short period of time. Now I'm giving it time. I'm out until October. And even if the the stock, as you guys know, there's a lot of times I'll choose the October timeframes or August timeframes or September timeframes. And here we are in June. And I do that even if I'm doing a short-term trade. I don't plan on holding any of my trades very long. I do try to ride them as much as I can. And for on semiconductor, it may take a couple of weeks for this to ride. Why stay in the Octobers, this October call options that I have right now? Why stay in that the whole time? Maybe, maybe not. Typically, I kind of get in, get out, get in, get out, and I ride it along the way. But the reason I chose the 34, and Julia brought this up when I talked about in the money on Airbnb, which I'll talk about in a minute. But the reason I typically go in the money is I try to, if you take a look at all these strike prices here that are like above where the stock is currently trading, you got 39, 40, 41, 42, et cetera. All these are out of the money call options. And all this price right here, this is what I call expensive options. You may be looking and say, well, Bruce, why would you say this is expensive? Because it's only $1.80 and the one you're taking a look at is trading above $6. You're looking at the value. It's like looking at property. You're looking at the value of the option, and there's no intrinsic value when you're talking about out of the money call options. So when I go back and I take a look at my $34 call options, and I look at this, my break even, I take 34 plus the $6. That gives me $40. My break even is $40. If I go by the ask price, it's $40.20, but it's $40 is the break even. And that means that if you take a look at where the stock's trading now, it's trading at 38.35. So that means I have most of this is intrinsic value. I'm paying very, very little. I'm paying very little for. You want to mute yourself, Karen?
Which people can criticize.
Let me see if I can mute her. Thank you, Kevin. So when you're taking a look at this, you're looking at the $34 in the money call options. There's only less than $2 of extrinsic value. So for me, from a professional trader's point of view, this is much cheaper than any of these out of the money call options. And there's times where I can go in the money, and you guys have seen me do it before, where I go in the money and I pay almost zero extrinsic value. So here, this trade right here, the October 34s, there's a couple reasons I do this. I made a decision between Skyworks was the other one, and I'll talk about that in a minute, Skyworks and this particular stock here. So why choose on semiconductor versus Skyworks? Well, if you take a look at this, I believe that realistically, this has an opportunity to go to about $45, $46 a share. Let's just say for easy math, it goes to $46 a share. And it takes all the way until the end of October, the 30th Friday of expiration date in October, to get to 46. What would these $34 call options be worth? Can anyone tell me?
Can you repeat the question, Bruce?
So if the trade gets to $46 a share, which is my price target between 45 and 46, let's just say it gets to $46 a share, what will my $34 call options be?
Is your intrinsic value $12?
Intrinsic value is $12. That's absolutely correct. So I'm not even counting extrinsic value. So if it gets to $45, $46 a share, 46 bucks a share, I'm going to have a double on my hands. And that's just counting intrinsic value. And that's if it takes all the way until October to get to that point. So I'll go ahead and essentially have doubled my money. And again, that's not including extrinsic value. That's just the intrinsic value of the stock. If it goes to $46 a share, this is a $12 value option of just based on intrinsic value alone. That's one of the big reasons I like this. So if we go back And if you don't understand that, just hold tight and you can ask a question again. I'll go into further detail on it. But I take a look at really, what do I think the realistic price target is going to be over time? And I put down my price target. I take a look at the option that I'm looking at, and I calculate the math based on intrinsic value of what that option is going to be worth if it reaches my price target. Now, if it reaches, let's say it goes to $45, $46 by the next week or so, next week, next 2 weeks. And is it possible? It's possible, because look how it's run before. And this is in a very, very short period of time. This area here is from May the 18th. This top area here is May the 28th. That's 10 days. In 10 days, it went from $36 a share to $40 a share. So a $4 run. So this thing has the ability to run. So if it did this in the next couple of weeks, well, I'm going to have a lot of extrinsic value built into this along with my intrinsic value. So I'll probably have more than a double in my hands. But here's what I take a look at. So someone else in the group had pointed out one of my other favorite stocks, which is Skyworks. So I came over to Skyworks. I like the technical setup of Skyworks. I look at this particular trade, just crossed over the 8 and 21. It is bumping its head on the 200-day moving average, and we did get a little bit of a fade. I did mention that. I said, let's see if we get a little bit of fade, and we did. But the other thing that I take a look at is, where do I think this particular stock can go in a shorter period of time? So when I looked at this, and I take a look at some of these areas of, like this area right here of this is a support area, is now resistance area. This area right here, and I'm just going to kind of zoom in here, but this area right here correlates with this area here. So this is, you can tell this is and you can see this consolidation here. So all that area that I'm looking at right here, this bottom area right here, that's 180, 181, correlates with this top area here, which is resistance. That's 180, 181, correlates with this consolidation here. So this is that 180, 181 is a pretty strong area of resistance. So when I take a look at this particular trade, if I go out, I probably wouldn't go out until November's, but if I take a look at the August timeframe, and I look at, let me see here on the August timeframe, I take a look at these. I think I was looking at the 150s is what I was taking a look at. Is that what I was looking at? The 150s? Let me see here. August 110s is what I was looking at. I was looking at the August 110s, because here I'm able to suck out as much extrinsic value as possible. So if we take 110, add on $65. I could probably get it cheaper than that, but let's say $65. That gives me a break even of 175. So just based on this premium of $65, doing the 110s gives me a break even of 175. That's pretty good. I'm not paying a lot of extrinsic value because the stock is only trading for 173 and some change. So I'm paying a little bit less than $2 a contract for extrinsic value. So I like that. I do like that. But again, now let's think about my target. If I go back here and I come back over here and I take a look at what I said my resistance area was, which is 180, 181. Well, if I come over here and I choose the 110s and it gets to 181 minus 110, that gives me $71 of intrinsic value. So if I take that and divide it by my cost basis of $65 a share, you may get it less, but let's just say 65. That's a 9% return. That's not bad, a 9% return, but that's not a double. And ON Semiconductor offers me a double versus what this price target is. If it reaches my price target of 181, I'm going to end up with a 9% return. Let's even say just for kicks, let's say this thing really runs and Skyworks really runs, and Skyworks can run. And let's say it goes up to $200 a share. Let's say it comes up to this $200 a share, which it could do. So we take $200, we minus the 110, that gives us $90, right? And if you say, well, Bruce, where are you getting the 110 from? I'm talking about my strike price. So if we hit 200 minus the 110, that's $90 divided by 65. That's a 38% return. That's good. 38% is good, but it's not a double. So do you see what I'm saying? So when I look at this, while Skyworks is a great trade, a great company, and I like it, I take a look at where can my money make the most money in the shortest period of time. And this is just a comparison of ON Semiconductor. This is how I think, so I take a look at, again, going back to ON Semiconductor, where I'm paying $34 and my price target is $46 a share. Even if it was 45, it's going to be a double if it makes it before October. But here I'm taking a look at a trade that I'm paying $6 and it reaches my price target. That's a $12 value without extrinsic value. That's a double on my hands. Versus Skyworks really has to make a big move, and still it's not going to be a double on my investment. So these are the things that I look for when I'm looking at different trades. I compare them on, I may like the company, I may like the setup, because you can see, look at this, look at the position on Semiconductor, it's good. Look at the position on Skyworks, it's also good. It's also good. But then when you start doing the math, and that's what trading is all about. How do you control your risk? What's the math? And that's the other reason that when Julie asked the question, why do I go in the money? It also decreases my risk, because now when the stock moves down on an out of the money option, if you're going out of the money, when a stock drops, you could lose 50% of the value of the option. When I'm in the money, deep in the money, it's like trading the stocks. It's almost like a dollar for dollar movement. There's no way I'm going to lose 50% of my option when I'm going that deep in the money. But at the same time, I can go ahead and make a double on my money or pretty close to it. So again, when you're comparing the trades, while they both look good technically, one is a much better trade than the other one. And for me, that's ON Semiconductor. So let me pause right there and open up for any questions that you guys might have. And if anyone's talking, you got to take your mic off mute. No, nobody has any questions? Okay, good enough. So let me bring up one that I've actually added to today. I started the position on Friday. The other one is called Airbnb. And Airbnb, I really like from a lot of different, I always look for not only the technical setup on the trade, which I have here, but I always take a look at what the catalyst is going to be. And, I went to the mall over the weekend. And when I went to the mall, there was a lot of people there. And you can see a lot of people are just anxious to get out and to meet with other people and interact again. And I think this is where Airbnb comes up, is that I think a lot of people are itching to get out. I think a lot of people are looking to travel again. And I think the hit that Airbnb took because of COVID cannot be overlooked. It's something that now it's an opportunity as we start to reopen again. I look at this and I've been waiting for a technical setup, and I started getting into it on Friday, scaled into it. As you guys always know, I like to scale into trades, put my toe in the water. With the markets down, you got to take a look at this too, guys. The markets are down 230 points on the Dow Jones, 230 points, the market's down. And Airbnb actually at one point was green. Now it's down 24, 23 cents. But you have to look for relative strength on your stocks. So the stocks that you really like, when the markets are down, that's when you take a look and say, how are they holding up? And I like this setup on Airbnb. I like the fact that we have a cross. I took advantage of the pullback, and I'm actually up positive on it, on the trade right now. When we take a look at Airbnb, let me see which one I did here. I did the Airbnb. I did the 110 call options, as Julia knows, so I put it into the chat, and I paid $40.60. Let's see where we're at. So I did the 110 call options, paid $40.60, and we're at 480 to 41.15. I'm green on the trade right now, even though it's down 23 cents. It was down further when I got into it. And that's why I say you can't be afraid when a stock moves down. You have to know where your pivot points are. You have to know where you're going to get in. So when I saw this move, the 8 move over the 21 moving average, I dipped my toe into the marketplace last week, but I wanted to get these a little bit closer together. And I was, and much like what Ben said, expecting a pullback in the overall markets. Here we're getting it again today, 237 points to the downside and climbing as we're speaking, 238 now. So I waited for a down market. I take a look at the stocks that I'm interested in, like Airbnb and some of these other ones, and I see what they're doing. And if they're holding still above a certain key pivot point, I start to dive in heavier. So I took advantage of that today. Now my cost basis is, $40.60, and I have a trade that's up in a down market. I'm green, and I'm going to hold on to this trade. Why? I could bail out and say, hey, I'm going to scalp the market. It's not what I'm going to do. I didn't intend this for a day trade. I'm out until October. I want to hold it for even if it's a couple of weeks, I'll hold it for. But if this thing were to take off and move up to this is how I think, guys. I'm just sharing with you my thoughts. If this thing were to take off and move up to this moving average, this 200-day moving average, which is about 153, I would go ahead and scale out of the trade. Why? Even though I'm a big believer in it, I would scale out of the trade just like I did. What was the other trade that I got out of today? Oh, it was Square. I'm still a huge believer in Square, and I'll talk about that in a minute. But when a stock makes a move and it hits a major resistance area, you can do one of two things. You can go ahead and look at it and hope that it breaks above the resistance area, which in Square's case and in Airbnb's case, it probably will. But also what will probably happen is it's going to bump its head and it's going to fade a little bit. And I prefer, as a trader, if it moves up to a key pivot point, this 152, 153 area, I will take my profits and I will wait for it to make a move over the 200-day moving average, and then let this trade fade back and test the 200-day moving average as a support level as opposed to a resistance level. And then I'll look to get back in. And guess what option I would get back into? This is the other reason I go out far, because now I become intimate. I get back into the same one, the October 110 call options. Why? Because now I become familiar with how this is actually priced. Now I become familiar with how this is actually priced. So there's a reason to the madness on why I go out so far as well. So Airbnb, I think it's a good solid trade. I think it's going to do well. And here we are still holding up in a down market. When the market's down now over 200 and 200 and almost 50 points to the downside. 250 points to the downside, and I'm green on the trade. So these are things that you want to take a look at. So let's take a look at Square. Another reason I exited out of Square this morning. I like the trade. Square is green on the day, up 10 points, almost 5% for the day. I like it, and it may get away from me. I may have made the wrong move by getting out, but who knows? My experience tells me, and I just go by the law of averages, my experience tells me when we make a move over a key pivot point like the 200-day moving average, at some point, it may not be today, and it doesn't look like it's going to be today for Square. I took my profits, cashed out. I will wait for the fade. I will wait for it to come back closer to this 200-day moving average. So somewhere between, and this is things you plan for, somewhere between 222 and maybe 224, comes around that area, 222, 224. I will go ahead and step back into the same option that I exit out of. And on Square, what was the option that I was holding on Square? Let me just take a look. I was holding the September $200 call options. So again, in the money on my trades, holding true to form. So I did the September $200 call options, and I exited out for 37.10. So I would have made a little more money because it's at 38.50 by 39. But you know what? No one's ever going to give you an award for getting at the very, very top. I like to get the meat, what I call the profit of the trade. So if this thing does pull back down, if Square does pull back down, and law of averages says that it will come down and test this 200-day moving average, probably come down to about 224 or so. If it comes down to that 224, well, I'm already telling you what I'm going to do. I will look at that same $200 call option, the September $200 call options, and I will take another bite of the apple for Square. Why? Because I believe in Square, and I like the things that it's doing. So again, patience pays. Patience pays. So let me bring up one final one. and then I'll open up for some questions again. And if you guys are quiet, then we'll close it out. This is the one brought up by Julia, one of the newest team members here. She brings up ticker symbol is U. So I'm not familiar with the stock Unity software, but I know how to read a chart, and I like the chart. So I got to go back and take a look at the implied volatility. I got to take a look at the other things that I go through on the chart. But from a chart perspective, it just moved over. And look at this, guys. So it moves over the 200-day moving average, and here it does a little bit of consolidation. So you rarely ever miss the move. So once it moved over that 200-day moving average, it consolidated right here, which would give me another chance of getting in the trade if I would have known about it. But I've never traded this company. So, but now look at where it's at today. It seems to me like money is coming in. You got higher volume on a move up. So money's coming into the trade. I think on Julia's, what I said was the August 80. So let me explain my reason for the August 80s by looking at this chart. So when I look at this particular trade, and this is just a purebred technical trade for me because I don't know the company. I go back, like I said, I got to go back and take a look at the implied volatility on it. And Megan, if you're on the call, maybe you can take a look at that real quick. But what I take a look at is I look at where I think the stock can go. So if I look at this area here at about 114, and you can take a look, 115, this area is pretty strong, a pretty strong area, a key pivot, what I call key pivot point. So we can go back in time and take a look at where there was a lot of consolidation here. We can take a look at where this served as support and then resistance. And we can take a look at where that top portion is of this area here. About 114, 115, 116. Let's just split it in the middle and call it my price target would be 115 on this trade. If I was taking a look at getting into it, 115 on the trade is what I would look at. So let's take a look at 115. And I said what? I said the $80 call options. And I haven't even looked at the option chain yet, but let's just look at this. 115 minus my $80 strike price. That's $35 is what that would be worth intrinsically if it got to 115. So if the stock gets to 115, which is pretty close to right now, and it's moving up, if it gets to 115, and I chose the $80 strike price, so this is what you want to pay attention to, guys. I chose the $80 strike price. 115 minus 80 is 35. Now let's take a look at the option. If I take a look at the, I gotta
jump off for a client, but the IV on that is 4.8.
Wow, that's really low. Thank you. Thank you very much.
See you guys later.
You got it, Megan. So 4.8 for the IV, guys. That's really what you want. You want it really low, and this is low. So that's another reason to get into the trade. So here are the August 80 call options. The August 80 call options, the difference between the price target of 115 and 80 is 35. If I pick this thing up for even $25, which I can probably get it less, but let's just say 25, 35 divided by 25, that's a 40% return. That's a pretty good return. And the stock doesn't even really have to move that far. So a 40% return on a trade, again, my case for being able to go in the money, because I'm always thinking about the risk factor. If this thing starts to move to the downside, you come over here and you take a look at what the deltas are on this. It's probably close to 1. Yeah, it's 90. It's a 90-cent delta. So it's going to move like the stock. So if this thing if you're going one of these out of the monies, you're going to get torched on this. But if you're going in the money, this behaves like the stock, guys. So that's the other reason I do it. I don't just do it because of profits and because of sucking out extrinsic value. If it moves down, you're going to get out. Yes, you're going to lose money if you don't have it hedged, but you're also going to be able to do what? You're not going to take as big of a loss because it's moving like the stock. You're not going to lose 50% of the value if you were doing a out of the money call option. So here we have a trade that's getting momentum. And I just showed you, if it gets to that 115 mark, you're making a 40% return. Let's take a look, and I haven't looked at this yet. Let's take a look at for kicks to see how we could hedge this if we were to hedge it. So with 4 days left, let's see what some opportunities are that we could do. So I would take a look at the 80s plus the $25 we're paying. That's a 105 break even. 105 break even. And let me get rid of this because I always like to look at volume and open interest. But 105 break even. So that would be taking a chance if you did this one here. But you still make money on the trade, just wouldn't make as much. If it got to 105 and you did this trade here, you would be, let's see here, you would do 105 minus your 80 That's a $25 spread plus the $1.80 you're going to take in. And you're paying 20, you're saying we're paying 20, so that's 26.80. You're paying 25 for it. So if you got called out, you'd make a 7% return. So that's not a bad thing. I mean, in 4 days, a 7% return, your bank's not paying you that in a year. So you could hedge this trade. You can go further out of the money, but you're taking less of a hedge. But let me just break this down for those of you that don't really fully understand this. If you wanted to hedge yourself, I mean, you want to protect yourself in case you like Unity software, but you think it's going to go up further, but there might be some breathing room. It might be a little bit of a fade as it goes up. You can try to reduce your cost basis by saying, let's say you pick this up for, let's say 25. You could probably pick it up for less than 25. Let's just say $25 a share. So I took 25 plus my $80 strike price. That's a 105 break even on the trade, 105 break even. So I could sell at the same time that I do this, I could sell the June, which expires in 4 days. It's this Friday. I could sell the June 105s against my trade. And this is as a protection, right? So that would reduce my cost basis by almost $2, $1.80 by $1.90. Let's just say you pick up $1.80. So, but you say, well, Bruce, my break even is 180 plus 25, my break even is 105. So I'm not going to make any money on it if I sell the 105s. That's not true, because you cannot forget the credit that you're taking in of $1.80. So if we look at this, we say 105 minus 80 is $25. Well, that's what you're paying, right? But then plus the $1.80 that you're taking in, that makes it $26.80 is what you would, if you got called out, if this trade went above 105 by the third Friday of this month, which is this week, you would be called out, but you would be called out with a spread of $26.80. You divide that by your cost basis of $25. And like I said, you could probably get it for less than that, but $25, that gives you a 7% return. So I wouldn't be mad if I made 7% in 4 days. But the thing that you want to do is, what you're really hoping to do is that this trade moves up to just slightly under 105, like 104.99, and you get to keep the entire credit. And what you're essentially doing is you're reducing your cost basis on the August 80s by another $1.80 that you just took in. So there's so many ways to slice and dice this, so many ways. Any questions on that, guys, before I close out? By the way, we're down 260 points on the Dow Jones, and I'm green. It's a good trade, though. Unity software, low implied volatility. I'm going to take a further look at this, but I just outlined that trade on either doing just a straight directional or doing a hedge trade, either way. But that's what I would take a look at if I was looking at this trade.
Hey, Bruce, it's Mike.
Hey, Mike.
Hey, so I just wanted to get a better understanding on the implied volatility. I went to the ivolatility.com, and I was having a hard time trying to figure out.
Let me break that down real quick. Let me share my chart with you. Let me go to my implied volatility, and I'll share this with you. Let me put it on my big screen. Makes it easier for me. Blow this up. One quick second, Mike. Okay, so this is what you're looking at here. Okay, you see the implied volatility chart, Mike?
Yeah.
So let's pull it up. Unity is ticker symbol is U. So I come over here and they log me out. Hang on a quick second.
No worries.
So for those of you that don't know, it's ivolatility.com. Here's my password. You come over here, hit historical charts. Put in the ticker symbol U, which is already there now. And I'm going out, what were we using on U? We were using the August. So about 90 days. So we take a look at-
It's the approximate, right? So that's it, okay.
Yeah, so we take a look at 48.23. That's where it's at right now, the implied volatility, but that doesn't tell you anything. You have to come over and take a look at where it's been. So it's been as, look at this, it's low. It's below low. So 48.23, The low is 45.04. The high is 121. So it's actually below. It's actually below the low from the data that they're taking. So it's like -0. The implied volatility is, and you can see on the chart here, Mike. You can see this chart. When you click on this, you can see this chart. Click on it. It's not allowing me to click, but you can see this chart, which is the gold line. It has fallen and fallen and fallen. Now, again, why do you want, for those of you that are new, why do you want low implied volatility? You want low implied volatility because that's how the options get expensive or they get cheap. So low implied volatility below a 30th percentile or 25th percentile is what I typically like to look at. And then if you get the direction in your favor, which it looks like on that stock, you're going to have direction in your favor. And all of a sudden implied volatility starts to turn around and it starts to run up. Could you imagine if this implied volatility goes from where it's at right now at 48 up to anywhere close to 121? That would be massive. So that's what you want. You want that implied volatility, which it typically will follow the price of the stock, and it will run up, and that's what you want. And that would even make it more of an attractive trade right there. Is taking a look at that implied volatility, but you have a very, very low implied volatility. Answer your question, Mike?
Yeah, it makes sense. It makes sense. Just to speak to some of your comments earlier, I did an out of the money call on Verizon, and I'm kind of taking a bath. So I made my mistake. Lesson learned.
Yeah. What made you do an out of the money call option on that, by the way?
I just thought it was going to go up to $60. So I just kind of was like, hey, I'll do that. And yeah, I now I know the difference. So now I'm kind of like, what do I do? Do I just cut my losses? And it's kind of that emotional part of trading and try to get a little more, I guess.
Clinical. I like I said, I like Verizon Wireless. I think it will go up. And you can start to see in a down market, it is starting to stabilize here. My uncle point for me, my uncle point where I would say, boom, I'm going to cut bait was right around 56.80. That's what I wrote down on my notes. 56.80. Yeah. This was a warning sign for me if it broke here. So that triggered my warning sign. 56.80 was my stop. So for me, it moved up. It didn't hit the 56.80. It moved up. It's at 56.93. But why for me get out? And this might help you answer your own question. When you take a look at stocks like what we just looked at, we looked at Unity, right? Which is on the move and very, very low implied volatility. We took a look at ON Semiconductor, again, baselining in a down market. It's up 53 cents in a down market and it's moving up. You take a look at even Skyworks, which is not my top pick, but I like the stock, but even Skyworks in a down market up $1.80. And then you go back and you have Verizon. So in Verizon, it's holding. It's not down big, but it's holding. And it'll probably, like I said, it'll probably consolidate. And these are the things that went through my mind, Mike. They'll probably consolidate and, it's going to take us some time and it probably will move up to 60, but it may take another 3 weeks to do that. Well, shit, by the time 3 weeks comes and goes, I could have made money on Semiconductor and Skyworks and Unify Software, all those things. Where here I am sitting, holding on to something that is going to take 3 or 4 weeks for it to materialize. That's when I looked at that and I thought, you know what, I'm going to cut bait on this thing, and I did.
And so you take a loss and you just move on.
I moved on with it. Because the other thing too is that you're going to have so many opportunities. You take a look at like the one Ben brought up before. The one Ben brought up where we're looking at. We take a look at Airbnb, which is one of my favorites, just based on the catalyst. I mean, I think this thing moves well above the 200-day moving average. I'm just counting on it to move at the 200-day moving average. For the trade. But you have things like Airbnb, you have things like Square, if you're patient enough and you let it fade a little bit and see if it comes down to this area here, that gives you an opportunity where you can make some money. The one that Julia brought up on the trade, it had baseline and now it's taken off and low implied volatility. So, and then you have, like I said, you have Verizon, which is going to be a while before, I think, in my personal opinion, before it runs. I think it's a good company, and they're doing great things with 5G. You see T-Mobile that talks about they have a bigger footprint. That's not true. They're talking about if you do your research, they're talking about a completely different 5G than the, I forget what it's called, ultra wave, than what Verizon's using. Verizon is using true 5G, and they're spending a lot of money on that. And so I think this Verizon is going to be a big player in that space. But even having said all that, Mike, I got to ask myself, I want my money working for me today, not 6 weeks from now.
Yeah.
Looking at opportunity cost there, Bruce, right? So like
opportunity cost.
So if you're in the trade for more than a week or so, you're looking at the compound interest that you could have made on the money rather than holding the money in a trade and not making that compound interest over time. Yeah.
Yep, exactly. I mean, I'm always looking to put my money to work, and there's great trades, Mike. I don't get into stupid trades. I get into good companies, but that doesn't always mean that it's the right time. I mean, we saw that with Kopin, we saw that with Kopin. This is a long-term play for me. You said, well, Bruce, you've been in and out of it. How can you say it's a long-term play? It's because I get in, I get out, I get in, I get out. And I start to become very familiar with the trade and very familiar with how the stock runs. But you look at this, in a down market that we're down 250 plus points, Kopin is up over 1%, over 11%. So you'll miss opportunities like this if you have your money tied up. And I'm just talking from experience. You have your money tied up in a trade that you're hoping turns around, even if it's a good company like Verizon, but it's not the right time. In our business, in real estate, it's location. In trading, it's timing. So you can have the right company, but the wrong timing, and you're going to lose money. You can have the bad company and the right timing, and you're going to make money. If you have the right company and the right timing, you make a lot of money. And that's what I'm trying to get you guys to do, where you're taking a look at good companies, but you're also looking at the right timing. And as it relates to doing out of the money calls, I mean, guys, you can do what you're going to do, but I keep preaching to you. The only time I do out of the money calls is if it's with a small amount of money that if I lose it, I'm not going to worry about it. It's going to be like, all right, I lost that. That was a lotto play for me. I'm going in the money and it's kind of like what Julie had brought up. She goes, oh, and a lot of people make that mistake. Oh, those out of the money, that's cheaper though. You're buying an expensive one. No, you're not looking at the raw dollar amount. You're looking at what's the best value. What's the best value for my money? That's what you're looking at. And that's not going to be an out of the money call option. The only time I will do an out of the money is if I see something like an unusual option activity. I hear a rumor that's coming out. And even then I'll put on the trade, but it's going to be with a little bit of money that I'm okay with. Otherwise, yeah, otherwise it's in the money, brother. It's got to be in the money. I mean, otherwise you'll destroy your account. You really will.
On the flip side, if an out of the money call goes the right way for you, though, you can make a lot of money, right?
Yeah, you can make a lot of money. But again, go back and take a look at, like on Verizon, for instance. Let's just take a look at Verizon. Here's what I would take a look at. So what option did you do?
I did the October $60 call.
Okay, so let's take a look at this. You guys are gonna learn from this. So watch this and take notes on this. You're gonna learn from this. October $60 call option.
Yeah.
And what did you pay for this?
I paid for that. I think I paid. I averaged down. Hold on a sec. Put me on the spot here.
That's okay. You know what? It doesn't even matter what you paid for it. It doesn't matter what you paid for it. What was your price target on it?
I believe my price target was like $60.
Okay, so $60. So here's a big mistake. So if this thing gets to 60, intrinsically you haven't made any money. So what are you counting on, Mike? You're counting on extrinsic value. If your price target is 60 and you're choosing the 60s and it gets to 60, intrinsically you haven't made jack. You're counting on all extrinsic value. So when I take a look at this, let's say that I chose the, well, actually I'll do what I chose. I chose the 5250s.
Yeah.
Shows the 52.50. So the 52.50s, let's say it gets to 60. $60 minus $52.50, which is my strike price, is $7.50. $7.50 divided by what I'm going to pay for it right now is $4.70. I would have made 60% return on my money. That's just intrinsic value. That's not even card. So if we're going to play fair and we're not going to count extrinsic value,
right?
If you count extrinsic value, then I'm going to count extrinsic value, and I can say, well, I'm going to have another $2 of extrinsic value. I'll have a double in my hands. But in intrinsic value, doing the 52.50s, I will, and we both have the same price target of $60 a share. I will have made 60% on my money. You will have made 0.
Oh my goodness. I think I paid 79 cents.
Yeah. Yeah, bro, that could be. I mean, there's so many other trades out there to I mean, even if it went up tomorrow and it's like, shit, I should have held on. You know how many times I've said that? It's just, you develop better discipline if you follow your rules on where you're going to get out and you take a look at the trades. I mean, look at all the things that I've taught you in terms of my technical indicators. Look at these technical indicators. Are they going up or are they going down?
It's bad.
They're going down.
Yeah.
You know, someone on the call, I can't remember who it was, when I brought up UAA and I said, I'm going to short UA. Well, shit, I'm glad I shorted it because I made a lot of money on it. Why? Because I believe when I got across to the downside, people question that. Well, Lululemon's going to the upside. I don't care about Lululemon. There's something going on with Under Armour, and it fell from wherever it is that we got it. I don't even remember now. And it traded to the downside. Why? Because I trust my system. It's not 100%. There is no system that works 100%, but it works enough where if you use good risk management, where you get out of trades, you don't hold on to them, it works for you. So Verizon Wireless, as much as I like it, how are you going to feel if the technical system that I introduced you to holds true and it falls further and goes down to $56 a share, or it goes down to $56 a share. So right now we're at almost 57, 56.90. So an out of the money call option, that's going to crush you.
Yeah. So I guess when you do deep in the money call options, it ties up cash. So like that would have been a $5,000 bet, right? As opposed to, me putting out my whatever. But I guess it's all, as you said,
a $5,000 bet at 60%. You would make $3,000 in your pocket profit.
Right.
So is it expensive?
It just takes the cash flow. That makes sense. Okay. Because I guess that was what I get shied away from, is just the bigger amount to put down.
I used to have that same struggle, man. I'd go through that and say, gosh, but I'm going to use up X amount of dollars and stuff like that. You got to look at the risk involved.
Right.
On yours, on out of the money trade, any pullback, and it hasn't even dropped that much. It hasn't even dropped that much on your trade, and you're down 10 cents. You know what I'm saying?
Yeah.
This thing drops $1 and you're giving it time and stuff. All of a sudden, time decay kicks in and everything else. I mean, the good thing is you're out to October.
Right.
I would just say, try not to make it a habit of going out of the money. We always have a saying: you do too many out of the money trades, you're going to be out of money. I don't want to see you do that, Mike. I mean, you got a good head on your shoulders, and I think you're going to get this game of making money in this market. We're not going to be right on every single trade. You take profits where you can.
Okay, then let me ask you this one. How about Chewy?
What's the ticker symbol?
CHWY.
So I mean, it kind of looks like Verizon.
Gotcha.
Yeah. When did you get into this?
I didn't get into it. It's just something I've been researching. It's like a dog food company. Yeah.
I mean, if you like the company, patience pays. Ben always laughs. He hears me say that all the time. Patience pays, though. Wait. This. People, well, Bruce, what if I miss the move? I don't see Chewy going to be jumping up, $20 overnight. Unless you know something I don't know. The charts tell me wait for a consolidation, let it consolidate. As it consolidates around this area, which it looks like it's starting to do, consolidates around 74.50. If you still like it and implied volatility is low, boom, make it move for it.
And like just about your crossovers, right? So is it when the lines actually cross over, or is when the candle crosses the line? Because there's a little bit of confusion there, I think.
Yeah, right when it crosses over. right when it crosses over. Unless you're really familiar with the trade, for me, like Square,
Yeah.
to $200 strike price, $200 was a key pivot point for Square. So I'll trade off of key pivot points as well. But if I trade off of key pivot points, I'll tell you I trade off of that. But if you wait for the move, you say, well, Bruce, I'm going to miss the move. I wait for the crossover. Well, there's the crossover on Square at 2. Even if you waited for the move, which I didn't on Square, but if you did, you're getting in at 215, and today it's trading at 230.
Can you zoom in just a little on that one?
Yeah.
Just on that crossover.
So here it crossed over. Maybe you get in on this day here at 216, and it continues moving.
Gotcha.
Good questions, though. Anything else, guys? Nope. All right. Hopefully you guys enjoy this. I appreciate you guys taking the time to join. And I will go ahead and when this processes, I will go ahead and upload this into one of the guides and let you know in the chat which guide I'm going to upload it into.
Thanks a lot, Bruce.
All right,
Appreciate you, brother. Thanks a lot, man.
Thanks, Bruce.
All right, guys. Take care now.
Thanks.